Okay, welcome to the Market Insights Roundtable for FIS Group for the fourth quarter of 2014. We are broadcasting live from the FIS Investment Symposium, our annual investment conference for our clients and our prospects and managers and friends. We're delighted to be with you here in Philadelphia today. And we've heard two tour de force presentations this morning from Dr. Satyam Pandey at Standard & Poor's and Dr. Vikram Mancharamani from Harvard and Yale, with the opportunity to learn much about what the economic climate and conditions are in the world right now. We have the opportunity to hear from the Chief Investment Officer and Chief Executive Officer of FIS Group, Tina Byles Williams, to bridge the gap for us, to take that economist view and to put it in terms of what we think of as investment practitioners. What are the implications that we should be looking at? And I'll just give you the hint right now that where we're leading is very similar to what Dr. Mancharamani had to say in his talk, that we believe frontier markets in particular, there's a long-term tailwind in favor of those markets, and that is probably one of the areas that's most underrepresented in institutional portfolios and the place where you can perhaps move the needle the most with a structural change. So with that, I'd like to introduce you to Tina Byles Williams, Chief Investment Officer, Chief Executive Officer of FIS Group.
Well, thank you all. Let me start by, before we get into where I think we should be going, let's talk about where we shouldn't be going. And that is looking back in the rearview mirror. We all think of ourselves as brilliant investors, and we look at, copious amount of data and chart our course. But if you actually look at patterns, we typically look through the rearview mirror. So this is a picture, obviously, of a car that was lucky enough to pass a tornado. Now, if you were in that car, let's say you were driving to work every day and you were lucky enough to escape a tornado, you would probably do two things. One, you'd drive like a bat out of hell to get to work. But secondly, the day after, day 2, day 3, day 4, you would, even though the probability of a tornado occurring in that spot is probably quite low, you would slow down because the memory of that tornado is still in your head. And you would slow down, or you may even change routes altogether when there is absolutely very little probability of that reoccurring. That's in fact what happened after 2008. We were classic trauma victims. We had gone through the trauma of the tech bubble in 2000 and then the financial crash in 2008. And we all acted like trauma victims and kept looking for the tornado in the rearview mirror. So this is how we acted after that crash. And so this evaluates flows into stocks versus bonds, and then the 1-year trailing return of the S&P. So you can see just at the worst point in history, first of all, we were overweight stocks. We bought a lot of stocks right before the crash. And then we went into bonds. The gold line there is whenever that's below 0, it means we're buying more bonds than we are stocks. And so we went into bonds. We de-risked. It was the term du jour. Some of you may remember I was a really frustrated conference attendee around the time of 2009, and every panel upon consultant and CIO, the only thing they were talking about was de-risking, running into hedge funds, and nothing against hedge funds, or basically running away from equity. 5 years later, and I would keep saying to these folks, look, you're fighting the wrong war. It was the last war, but it's the wrong war. If you look at 5-year trailing returns ending 2013, the stock market, just plain old stocks, actually returned 180%. Hedge funds, where everyone was running to, was about 7.5%. Even private equity, great investment. And again, please, this is not a rant against alternatives. I think they should be in your portfolio. But even private equity, for the privilege of locking up your money for 10 years, returned 110% versus 180%. So this is not about what happened in the future, but I will say, as we face the future, I think unfortunately, that opportunity, the window is actually closing with respect to public equity in terms of those outsized returns. But it is a message to let's look forward, lean forward as we formulate our investment strategies going forward.
Okay, so as we stop looking in the rearview mirror, Tina, and we take what we learned the last couple of hours about the macroeconomic picture, what are maybe the first couple of things you'd say there to bridge us over, begin bridging us to an investment view?
Sure. So, no, we had some excellent talks on the macroeconomic picture, and I agree, so I'm not going to belabor that. I'll just use two slides to sort of set up where I think we are and where we should go. So the first thing is, looks at GDP growth relative to long-term trend growth, which is typically about 4% in the US. So not telling you anything you don't know, that after 5 years of a recovery, and so you see that line goes up after 2009, we're still below trend. I just last week in New York, I heard a presentation by a professor from my alma mater, Carmen Reinhardt, who with her husband, Ken Rogoff, did a seminal work on sort of the reaction after financial crashes. And she said that it takes about 6.5 years, typically, to recover, to get back to pre-crisis levels. And so we're basically on track. She also said within the 6.5 years, there are typically growth scares, and so we have followed that pattern almost perfectly. So we're on track. Let's see, there we go. But you know, as Vikram said, we are the best kid in summer school. So this is the world in that, and it has a lot of implications, I think, for future investment strategy. In that, obviously, we had a balance sheet recession, and that's why it's taken so long to get on track, in that people are indebted, they're not spending. What usually fuels a recovery is people borrow to spend, and it fuels demand. People aren't borrowing because they already have a lot of debt. So bottom line is, you have a lot of slack in the global economy, and that's the blue line there. And you have a lot of savings in the economy. If you can, in addition to the dynamic I just described, is in countries like China, where there's underconsumption, there's still a lot of savings sloshing around in the world. So while we are closest to tightening, I don't see that as an event. I see that normalization, even in the US, which is sort of ahead of the game, will take a long time, precisely because there's just too much savings, too much slack in the world. It goes back to what Vikram said. If you sort of look at the US alone, yes, we're clearly on the path to the recovery. If you look at the US in the context of the entire globe, through the exchange rate mechanism of the dollar, which will further sort of deflate the economy, I don't see that any sort of imminent and sharp rises in interest rates.
Okay, so if earnings aren't growing dynamically. Maybe they're growing a little bit, but not dynamically. There's not a lot going on in the labor market to push demand. What are some of the things that have been supporting stock prices?
So one of the things, and I forget which of the two mentioned this, was this notion of corporations borrowing money cheaply to buy their own stock. And that was enabled by two dynamics. One was obviously the Fed anchoring rates, but the other was the action of state and local pension funds and private pension funds. You can see that this looks, first of all, at cumulative stock purchases, and you can see that pension funds, both private and state and local, were actually were net sellers, basically, of stocks. What were they buying? They were buying corporate bonds. So then that further anchored the borrowing rates of these corporations. So if you look at the sort of contribution to the cumulative stock of equities that were bought, most of it came from company buybacks. And that had a very nifty other effect. One, it obviously drove up their price. And so if I'm a CEO being paid on the performance of my stock, that's a pretty nifty thing. It also drove up earnings per share because I'm reducing the sort of the outstanding volume of shares, and so it drives up earnings per share. I'm also being paid on that. Nifty little thing. If you actually look at the S&P, you can see exactly this contrasts the buyback index with actual S&P, and so you can see that the buyback index trumps the performance of the S&P itself.
Okay, so if there are corporate exercises and balance sheet manipulations going on, buybacks supported the markets, and market was down, 265 yesterday. Should we be concerned about valuations at this point yet?
Vikram was very eloquent. No.
Technical term.
No. These are some of the things that we look at. And you can see, obviously, green means we're okay, yellow, caution, red, really caution. So on market indicators, some caution there. Obviously, I don't think the market is, in stratospheric levels, but it's certainly not cheap, much like what Vikram said. If you look at things like margins, stock margins, not, high, but not near prior peaks. I'm going to go to the global indicators. Those bring some concern. Obviously, there's been some disappointing news out of Europe and Japan and the EM. On the other hand, global ISM, or production, is fairly robust. And then on domestic economic indicators, they seem to be chugging along. Again, not have a party over them, but certainly not at a concerning levels. So I'm going to end with our own proprietary indicators, which is the systemic market risk indicator. And what that does is it actually pulls data which we've found to be leading from different sort of aspects of global economic activity. So it will look at the Chinese A and H share market, at commodity currencies, global spreads,